So today, finally, I said F it, and I started shorting the S&Ps.
The big asymmetry right now is, what's not normal right now?
How real is this growth, or is it just all based on debt?
We are kind of downshifting from. But to your question though, where's the trade? Where is the dislocation between the economy, the policy reaction function, and what is pricing the economy?
You know, make me some money. Hello, everyone. My name is Tony Rehan, and today we have a very special guest joining me, David Cervantes, a leading voice in the financial markets. With over 20 years of experience at the highest levels of finance, David has become one of the most respected and insightful minds on FinTweet. His commentary on the markets, monetary policy, global trends has made him a must follow for anyone interested in macro and economics. Well, we'll be talking to David about his thoughts on the current economic landscape, investment opportunities that he sees, and most importantly, how we can take actionable trades based on his views, because this show is called What's the Trade? David, thank you for joining us today.
Hey, Tony, thanks for having me. I appreciate it. Really, really glad to be here.
It's an honor having you. I read your stuff; it's amazing. You have one of the best economic minds that I have read, and you're very accurate, which is very hard on macro. And I've made some good money following you. So thank you, David, for all
All
your
right,
thoughts and advice. Thank you.
I'll send you my address for a beer.
Of course. Excellent. Say, why don't we start talking about a little bit about the economy, how it's doing? Where do you think we are right now?
Yeah, so just coming off the back of Q3, where we had a 4.9% GDP growth rate annualized, that was just a whopper of a growth rate. And we are, back in September, I put out in my research notes that we were likely going to slow, not because of anything necessarily bad, but just because a 4.9% growth rate in a mature economy like the United States is just really not a sustainable thing. It's just this is more of a mean reversion thesis, and this has nothing to do with interest rates, has nothing to do with whatever. It's just an economy this mature doesn't grow that fast.
Right.
And 4.9% was kind of an outlier anomaly. So the idea was that we would start to slow. That thesis got a little tested back in October with a strong retail sales print that was just crazy. But that you got to remember the October release is for September data.
Right.
Obviously the fourth quarter got started in October. So now where we are, to answer your question, is we are kind of downshifting from that 4.9% to a much lower growth rate now.
Yeah. Do you think that we're slowing because the government's spending less money? And if we look back at President Trump tenure, I'm not a macro expert like you, but I can see the U.S. debt growth similar to the GDP growth. And with President Biden, also they're printing money, they're issuing treasuries like they were going out of style. So I really want to ask you, how real is this growth, or is it just all based on debt?
Good question. And I don't really know, and I really don't care because what I'm looking at is how to make money off of it. I think if you get caught up in the semantics of the growth is fake or the numbers are fake, you're going to go down a rabbit hole of losing money. So I trade what's in front of me and the
Right.
data that's in front of me, and that's currently strong economic growth, slowing, a non-recessionary slowdown. But to your point, yeah, there's been a massive increase in debt. The stimulus was more than a helicopter drop. I mean, they really brought out the bazookas. This is World War II style stimulus. I mean, just in 22 and 21, we did about 28% of GDP expenditures in stimulus. I mean, we just have not seen that since World War II. So yeah, there is a valid point to saying, this is, debt fueled stimulus, but for traders, why should it matter? It doesn't
Right.
matter.
Doesn't matter.
Um,
But
I
what
mean, it
does
matters to
matter?
the extent. Go ahead.
No, no. So I think, but what might matter is what you were talking about, the consumer. Retail sales give us a little insight on how the consumer is doing right now. And I think retail sales are not healthy at all right now. And if you see the consumer debt levels, they're quite high. And I'm worried because the US economy, is 60, 70% consumer based.
So the retail sales report in October was really, really strong.
Yeah.
And also, I think one thing that's, consumer debt levels, I think we should look at aggregates across the economy and across individual consumer balance sheets. Individual consumer balance sheets are really strong right now. Home ownership levels, the amount of equity that is 100% outright owned is at historic highs. We really delevered after the global financial crisis. So there might be some pockets of stress, whether it's student loans, whether it's from credit cards, but in the aggregate consumer balance sheet is very healthy, very strong, but more importantly, job growth and the incomes that are generated off that job growth are doing really well. So, the debt is kind of a side issue as long as the income is there to support the debt servicing.
Right.
And right now, with unemployment rate is quite low. I mean, it ticked up today at 3.9, hit a low of 3.4 earlier this year. It was at 3.8 as of yesterday. New unemployment NFP number came out, 3.9. So the labor market softening up a little bit, but that's considered a normalization at this point because it was pretty tight.
Hmm.
And as long as the income growth is there to support whatever debt burdens, I think it's a side issue. The consumer is they're working. As long as people are getting up in the morning, going to work, they're going to spend. They're going to pay their mortgage. They're going to send their kids to school and do all the things that we all do.
Right, right. So you're not also worried about people starting to pay their student debts. I think it's going to be like another $400 a month that people didn't have on their budgets. They're going to have to start paying it right now, and maybe that will affect a little bit. Who knows?
The way I look at these headlines or macro issues is you take the number in question, student loans. I don't know what the number is, 400 billion, whatever, and
Right.
you divide it by the size of the nominal economy. Right now, we're at 28 trillion. It typically comes out to a very small number. So that's just my simple back of the envelope.
Yep.
It keeps me from stressing out over these kinds of things. Just take that number, divide it by 28 trillion. You
Mm.
get a small number. It really doesn't matter in the aggregate. Um, so
Okay.
I think the bigger, I don't know if I'd say concern right now, but the sustainability of the debt longer term is an issue. In 2032, more money will be spent on interest than on anything else. That
Right.
interest servicing will eat up a bigger part of the budget than anything else. But honestly, that's a 10 years away problem, and that's ultimately a political issue.
Right.
It's not a today problem. It's not something you can trade around. If you want to trade around that, you will hurt yourself.
Right. And based on your economic outlook right now on the big macro, what do you think? Are all the retail investors that are watching us or institutional investors, what is a trade? What do you think we should be looking at to
Well,
benefit?
I start with we're looking at the generally at the economy first. That's where my framework starts. Looking at the economic growth rate and the inflation growth matrix, right? So, um, the economy is downshifting.
Yeah.
Looks like interest rates may have hit a local top. Who knows where they go? That's
My God.
anyone's guess. But for now, I think we peaked at 5.02%.
Yeah.
They have been declining. And then in the last 3 days, starting on Wednesday, we saw a massive waterfall in yields. I think we dropped as low as 450 this morning. I think we're now at 455. I'm not watching, but you know, good enough. So the economy, the bond market is starting to price in the deceleration in the economy. Last on Wednesday, the Atlanta Fed downshifted its growth estimate. It was previously at 2.3, I believe. Now it's at 1.2. Is my recollection. The numbers really at the margin don't really matter. The bottom line
Right.
is, you know, the idea of a slowdown is becoming priced in by markets. The bond market's reflecting that. So then from there, what's the trade? Well, we start looking at the bond market.
Yep.
The,
Yep. I have
the bond market's very, very, very savvy. It's
yep.
really hard to get in front of it.
Yep.
I and my subscribers were positioned, uh, for that. We got lucky. There's obviously always an element of luck.
Yep.
Rode that down from 370. I'm sorry, 479, 481, down to the low 460s. We got a little lower today, but that was a great trade that we put on, executed. Obviously, once you get the bond market, you can start building out other trades, whether it's decline in volatility or increase in volatility, and stocks, and
Right.
from there. But it always starts with the economy for me,
Hmm.
and then going to the bond market.
Hmm. You had a
Um,
great call a few months ago about shorting the bond market. You were absolutely right on that. And but now we can see the bonds, starting to get a bid. Me personally, I am a contrarian. I like to trade contrarianly, and I have right now quite a sizable position on TLT, sizable position on the ZNs and the ZBs, and if we can take a look at the charts, they're starting to bounce a little bit, and so we're finally starting to get a bid on the bonds, which is giving my position some relief. But I wanted to ask if you see this continuing, or is this just a dead cat bounce?
Good question. So, we need to go look back at what are the drivers. I think the risk premiums got they started to expand. I think they hit almost 50 basis points on the 10-year, prior to Wednesday. Wednesday we had the QRA, the quarterly refunding announcement by the U.S. Treasury. That's when they come out and tell us how many bonds they're going to float for the next 2 quarters. So fourth quarter and Q1. The market was really on pins and needles, thinking that there would be a massive amount of issuance that would just make you have a flood of supply that would drown the bond market in paper, and the bond market would reprice lower. That did not happen. So we had a risk. That was your first risk on catalyst that really said the bond market had a moment of relief, and that whole risk premium expansion started to get bid. Bonds started to get bid and bought up. So what was the catalyst? Well, less supply. That's one thing. The other thing is the Fed also on Wednesday came out and said, they had their Fed meeting, no changes, but basically the Fed is on the sidelines. Also on Wednesday, we had the Atlanta Fed giving us the downgraded GDP projections, and finally, also on Wednesday, we had I believe it was some PMI numbers that came out around 10 o'clock in the morning. So if you look at the tape, bonds started really catching a bit around 9:30 in the morning, heading into the PMI numbers, and just strengthened up all day. So you had four things that catalyzed it. You had this perfect storm of these four factors
Right.
that came together and just ignited the market. And then
Yeah.
things got settled down a little bit yesterday, and then today with the soft NFP number came in at 150. We're expecting 180. It shows the deceleration taking place. The job market is softening. No longer, it's starting to normalize. Again, that put a bid under there. So I think you've had a lot of energy expended on the bid. I do think that this was a relief rally where the worst case scenario was taken off the table and everyone's breathing a sigh of relief.
Yep.
I think for now there will be a pause in this. I don't think I am personally flat. I took profits
Oh, okay.
yesterday.
Good job.
But I think I am waiting for a pop back up in yields to get back involved again. But I do think we did put in a local top for now at 502, and if we get near 480 ish, that's something I would revisit.
Most contrarian traders, they see the TLT go down from almost 180 to 80, 85, and they're salivating, like a chance of a lifetime to get in. And I was one of those. And what I've been doing in the last couple of days is I haven't reduced my core long delta position on TLT or the bonds, but I've been selling calls against my position to reduce my cost basis. And because that's one of the basics of trading is cost basis reduction. So what I've been doing, and I sold calls yesterday. I think I sold the 86 calls yesterday for almost $3. They're $4. The calls are $4 now, so they're a little bit underwater. This morning, before we jumped in, I sold the 88 December calls on TLT for almost $3 again. So I want to take advantage of this pop to reduce my long position. I'm holding my long bond position. I think it was overdone, maybe, but bonds move fast, stocks move very fast. But I do want to get in if we have a chance, if yield starts spiking up. Uh, I want to take profits on my calls and maybe and get long delta again, and hopefully we get that dip, because I don't think we're out of the woods yet, like you said, and I think we're going to have a chance. The CPI number, I think, is going to be a big catalyst to see if this bond rally, has staying power, or it doesn't. But today, I think the bonds have stalled out. I mean, they rallied crazy. They almost went to 82 before the Fed meeting. The TLT was at 82, 83, and now it's almost 89, 90. So, wow, what a run! A run!
Yeah, I can't comment on TLT just because I don't trade it. I mean, I trade futures,
Nice
and
line.
I do that mainly for the almost 24/7, well,
Right,
23/5 liquidity,
right,
and it's also just they're really cheap to trade as well.
right.
But I think for retail,
Yeah,
that's a way to
right.
access the
Yeah,
rates market for
yeah.
sure.
Yeah,
Um,
the ZB bonds went from 107 to 113 in 3 4 days. It was what a
Yeah,
move.
no, it was really wild. So I think now what I'm watching is how the economy is evolving and how the Fed reaction function is evolving relative to changes in the economy. So after today's NFP report, the chances of a hike in January went from 30% down to 20%. I think the Fed's done. I mean, they're clearly done for this year. I mean, there's this just not happening. Short of some inflation bomb going off, it's just not happening this year. It's done. And then, now we're looking at when is the Fed going to cut? Before today, the idea was that they'd cut in June, and now the bond market is starting to price in cuts in May. So that is, I think because the bond market is so efficient and so transparent, it's very hard to profit off of it. The way to profit off of it, I think, is to look at dislocations between what is happening between the economy,
Hmm.
the Fed, what the Fed is projecting, and the pricing in the market relative to those other two factors. It's really hard, but you
Yeah,
can get ahead of it if you do the homework and you're patient and are probably willing to take a few lumps.
yep,
It's doable, but it's tough,
yep,
and it requires little luck. But
yep,
I think that's the way I approach the problem set is trying to
right,
understand where is the dislocation between the economy, the policy reaction function, and what is pricing the economy.
yeah,
So what I see there is, the economy set to slow. Question is by how much? I
right,
think the Atlanta Fed GDP is looking at 1.2. They've been very accurate, and this is a moving target. This changes from week to week with
yeah,
all the data releases. But I think we're going to end up around 2.5, just because it's just simple momentum math. We came out the gate at
right.
4.9 from Q3.
Hmm.
And to go from 4.9 to 1.2 is a real deceleration.
It is.
I don't think we're going to get that magnitude of deceleration. So I've got, back of the envelope, 2.5% built, locked in there.
Yeah,
And then you go, so what's the Fed thinking? Well, they're going to keep telling us that every meeting is live. They have to tell us that. That's their job.
right, right.
They got to keep the market on its toes. So, for now, the Fed's on the sidelines, but they're telling us that the meeting is live.
You know,
And then, yep.
mhm. On the three factors, inflation, unemployment, and GDP growth. Inflation, I think, peaked around June, maybe last year, when it was CPI was 9.1. Then it went down, 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 all the way to June 2023 to 3%. But recently, the end of the summer, we saw a little uptick, 3.2 in July, 367 in August, 370 in September. So how important do you think this factor is for the Fed to stay higher for longer? Because that, I'm always wrong, but I might be. I'm thinking that we're going to be higher for longer than people think. And what if inflation spikes up again?
Sure. I mean, I think the real risk for the inflation is if, we start seeing, well, there's two risks, two big risks I see. The first one is energy, right? With all these, geopolitical tensions in the Middle East, so far that has not manifested itself in any, price spikes in oil. But should that turn into a broader conflict that threatens supplies, then that becomes a risk. I don't think we're there right now, so I'm not really factoring that in. I think that the bigger issue is, in the housing market, there is a structural shortage of homes in this country.
Right,
Even
right.
despite rates, despite rates at all time highs, sales have kind of cratered, but prices haven't really fallen back much,
No,
if at
no,
all.
no, no.
And in fact, they're up around 1.2% this year, if
Yeah,
anything. So,
no,
so
no, no.
you know, so you know, in
You're
a typical cycle, rents follow home prices with about 12 to 18 month lag, and with home prices not really responding to changes in rates or the higher rate environment, um, you know, rents have not had their usual pullback. So as a result, OER, owners equivalent rent, which is 40% of
right.
core CPI, that is still very elevated compared to what where we thought it would normally be by this time. By this
And
time, OER should have been a non-issue, but it's like at a seven handle still. So that could still feed into inflationary pressures
right.
in the near term.
Now, I wanted to ask you, do you think the U.S. homeowner is smarter than the U.S. Treasury Department? Let me ask you why. So, when rates were low, most homeowners, you were correctly mentioning that people are not selling their homes because they're locked in at a 30-year mortgage. People in other countries can't lock in more fixed rate mortgages that low. The U.S. Homeowner or consumer is blessed by having that. And I think a lot of people refinance their homes and locked in the low rates at a high level. But the U.S. Treasury also had a chance to refinance most of their debt, and they could even potentially they could have issued a 50-year, 100-year bond, who knows, or lock in 30 years or even 10 years with the really low rates, and they did not do it. So here is an instance where I think the consumer, the homeowner, was smarter than the Treasury Department, taking advantage of the low rates, seeing that inflation was not transitory. In my point of view.
I mean, I think the American consumer got really lucky. I mean, here's a great example. I am by no means a mortgage arb person, but we have a low rate mortgage, and we just happen to kind of have we have young kids, we're not moving, so I think a lot of this was in my case, my personal case was kind of circumstance where we just had this low mortgage. We have three young kids in school. There's no need for us to move, and you know why?
Right,
And I
right,
think I think a lot of people find themselves in that kind of a situation. I mean, I think there are some frictions at the extremes with older people who maybe want to downsize, but they can't because they've got this two handle, three handle mortgage, and now they're looking at a seven handle mortgage, assuming they could even get credit. So I think at the tails, the wings, you do have those frictions popping up. But I think most people are kind of like in my personal situation where we just got kind of really really lucky.
So,
Um,
what do you think is going to play out? Do you think we're going to see prices go down, or because everybody's waiting for prices to go down to buy a home, or they're waiting for interest rates to go down to buy a home? Uh, but where do you see home prices going?
Yeah, so I think the adjustment. So typically, price is price is the adjustment mechanism. Typically, we haven't had that this cycle. I think what the adjustment mechanism is going to be is size of house and location. In other words, mortgages, they'll do what they'll do because of the shortage of housing in this country.
Right.
Prices will stay elevated. Um, I think the adjustment factor will be, people have to either buy less house or move farther away from their desired location.
Wow.
That will be the adjustment factor, I
Right.
think.
Right.
Because if you're
Oh,
you know if you're a newlywed, you're a young couple, you have maybe one kid, you're living with your in-laws in the basement. You got well, who wants to be in that situation, right? You're gonna get the hell out as soon as possible. But how
yeah.
do you do it if you can't get a mortgage, or I'm sorry, if if you can't, if your affordability, which is at historic lows, is an impediment, you have to do what you got to do. And I think the easiest thing in that case is you get less house, and you
Right.
get less house farther away from where you
Right.
ideally would want to be, farther
Yeah.
from work, farther from your in-laws, whatever.
Yeah.
I
I'm
think
worried about,
that's going to be the adjustment factor. I think.
you know, I'm looking at it and say if we can't get house pricing down with 8% interest mortgage, I mean, when can housing prices go down? They're never going to go down. So I'm worried about my kids. My kids are out of college. In a few years, probably they'll get married. They want to buy a house. House affordability, I think it's at the worst levels ever. So it's almost impossible for a young person. But I've never thought about what you said. So you're going to have to buy a smaller house at a less desirable location, and I think that's very smart. Wow, David, that's thank you.
Well, and but to your question though, like where's the trade? Well,
Yep.
there's a secular. I think that the housing issue is obviously structural and secular. It's structural because housing is driven by demographics. It's driven by interest rates. It's driven by really slow moving factors. So I think this housing shortage did not go away with high interest rates. I mean, this is a secular thing. So what's the trade? Well, home builders. I mean, they came out the gate in October 22. I got long them in February of 23, and got long the home builders and had a great run. Got out in April. This is all time stamped. Got out in I'm sorry, not April, August. Um, Part of it was luck. I was going on vacation with my family,
Wow. Okay.
so flattened out risk there. But also that
Okay.
was part of the bond short trade, and we can go back to that later. But
Mhm.
I got equity risk in August, mid August. But I think that trade, even though it's petered out recently, has a lot of legs. The housing trade,
Yeah.
because people need houses, even
Yep.
if those houses are smaller, even if their houses are farther away.
Mhm.
People need houses. I think
Yeah.
that trade is secular and it has legs.
Wow.
Uh, the,
I'm looking at
the,
the XHB right now that you mentioned.
Yep, it
Uh,
just popped around. It just popped this week
yeah,
with the
it popped
pullback
a
in
lot.
rates.
It went from
Yep,
like 69 to 77. Wow, what a pop!
that's right.
Wow.
So it came out the gate, running out the gate last October, peaked in August. It's pulled back, but this is a blip in a longer term story, and people can play that however they want, technically, or buy and hold or whatever. Do your own homework on which
Right.
builders or buy the
Right.
index, but that trade is hot and it has legs.
Wow.
And I will
So
I
yeah.
will I will be looking to re-enter that trade at the appropriate time.
Yeah, we could buy the dips here. We could, on down moves, we could put bullish strategies, sell puts, put verticals, maybe go along with long call verticals, call ratios. So that's great. Yeah, the pop this week, unfortunately, I missed this trade, but I'm going to be looking at home builders more carefully. And
Yeah, I mean the thing with home builders is that they're very cyclically sensitive.
right,
So if you miss it here, look, they run with a cycle. So they're I didn't get in, but I'm watching it. It's on my watch list, and it's something I'll be looking to do on a pullback or when the cyclical conditions warrant the trade.
right. And I want to take a look at oil, if you don't mind, because I think oil could hurt the CPI, you know, CPI numbers if it spikes again. And here I have the oil chart. It's trending up, but it has pulled back recently, and I think that pullback is maybe will help the CPI print coming up. But do you see any other factors that could hurt inflation besides oil?
Well, I mentioned the rents, the
Right, the
OER.
rent.
If
Yep. Right.
rents don't pull back, that could put some inflationary pressures. But another thing that drives rents though is income, right? So rents are very sensitive to income growth, and we've seen average hourly earnings pull back. I think they're 4.3 right now. They're starting to pull back, so that should eventually feed through the linkage of the housing market, of the OER slash shelter housing market, and relieve pressure on CPI. So that's something I'm looking at as well.
Right.
Oil, I don't trade commodities. I just don't have, it's just it's not my area of expertise or understanding. there are very smart, bright people that can do it very well. I'm not one of them.
Right. Are you worried about the banking sector? Because we keep hearing that commercial loans are going to be a big problem coming up. Maybe they're already a problem. They're just under the surface. It's like an iceberg just showing the top. And do you think all those commercial loan losses um, could have an effect on maybe the KRE, the regional bank index, or the XLF on the financials? Or do you see a trade there in the financial?
Two comments. One is the maturity wall that is associated with CRE.
Yep.
I know that's got a lot of people really terrified. That's a tomorrow problem. If you, I don't have it. In one of my research notes, I have the distribution of how the debt is termed out. Most of that debt doesn't come due until late 24, early 25. So for the next 6 to 9 months, it's not a today problem.
Okay.
And if the economy continues to soften and we start getting rate cuts in May or even in September or whatever, we'll see some relief, and I think that'll offset those pressures. But on that note, and this is not my area of expertise, but the mid-sized banks, the KREs of the world. I know Bill Gross is looking at that. I saw a blurb on Twitter. I haven't looked into it, but I know that he was trying to bottom tick that. So if people want to are inclined for that kind of risk, they can have a look at that sector and get the exposure they want to get based on their preferences and
Yeah.
risk tolerances. But I haven't had a chance to go through Bill Gross's comments on that.
Right.
But that is an area that's starting to look interesting to him.
KRE got really, really scary with Silicon Valley Bank and First Republic and everything. But then, the government came out and said they're going to bail everybody out. And I think that stopped the run on the banks. So, everything in the economy is confidence. And so if your deposits are safe, that's what people are worried about, right? If my money's safe at the bank, then there's no need to move it to JP Morgan or one of the big money central banks. So I think actually the Treasury and the Fed did a good job by backstopping the run on the regional banks, which are very important for local communities because a lot of people get their loans for their small business and from regional banks and. So it was a scary moment, but that's one of the moments where the
Well,
government did a good job, I think.
that's the kind of moment that creates these dislocations that I try to arbitrage, right? So I mean, I markets are efficient. Markets are really smart. It is really hard to outsmart the market. I don't like to play that game because I lose when I do that. I don't want to outs. What I try to do though is arbitrage the dislocation that's in front of me that I can see clearly and plainly. So what I mean by that? So when the banks were in trouble back in March, um, the 2 year note just got a really strong bid. I think it was on the order of 2 standard deviations above its normal bid. And it was crazy strong because a lot of people thought, "Oh my God, that's it, it's over." Flight to safety. And my understanding of the policy response was that they were not going to let 2008 play over again. 2008 was an existential moment for the economy,
It was crazy.
and then they said, "We are not going to let that happen again.
Right.
We will do what we got to do, and it's not happening again." Obviously they had to tone down their political delivery of that because people just don't like bailouts and
Right.
rich bankers getting away with murder and all this kind of stuff. So they had to tone down the way that policy response was delivered. But if you look at policy statements and what the goals were pretty clear that no, we're not going to let this happen. So to me, in my mind, that said, you know what, this bid on the 2 year note is way overdone, and I shorted the hell out of that thing, and this is all documented on Twitter. Shorted it and did it twice and came out pretty good on that. And
Wow.
again, that's the way I approach markets
Right.
and looking at arbitrage as a dislocation in front of me. It's very hard
Yeah.
to outsmart the market. Very
It,
hard.
it is hard, and because I've been reading your newsletter that I love, especially the study you did about the S&P valuation. But before we talk equities, because I really want to get your insight on equities, I haven't seen such a great you know study and probably real value uh, getting to real value of the S&P earnings. I really love that. But before we do that, do you see? I'm always looking for asymmetric opportunities to make a lot of money in, like you said, a very dislocated. Do you see any asymmetric opportunities right now that we can take a look at and maybe evaluate for a possible trade?
Yeah, so I think that the big asymmetry right now is, what's not normal right now. It's just what's not normal. What's not normal is an inverted yield curve. An inverted yield curve is not the standard, operation of things. The yield curve is upward sloping, right?
Right,
So right now we have and then this has nothing to do with recession prediction or any of this other stuff. This is just purely like, what does it look like? And a yield curve is normally upward sloping. So right now we have an anomaly, an inverted yield curve, right? So what does that create? That creates all kinds of distortions. And the big distortion I see is in mortgage-backed securities.
oh,
Mortgage backs, the way I look at a mortgage is simply, I model out a mortgage simply as a treasury that is short a call option. Why is
okay.
it short a call? Why is that?
I like
Well,
that. I like that. Yep.
the reason that is because a mortgage is federally guaranteed. I mean, they're not going to
Right.
tell you this, but we all know that mortgages are backed by the government, right?
A hundred
So it's
percent. A hundred
it's
percent.
credit it's credit risk free, just like a treasury, right? Now this concept of it's short a call option. Why is that? Well, you as a homeowner, you have the option to prepay your mortgage, right?
Right.
So
Right.
if rates fall, you can refi, or you sell your house and you pay off
Right.
your mortgage. You're done, right?
Right. Right.
So
Right.
if you have the option to prepay your mortgage, if you're logged that option, then the person that holds your mortgage is by definition short
They're
that
short that
option,
option. 100%. They're short. Yeah.
right? So that means that um, now you're introducing option pricing mechanics into this structure, right?
Right.
And what's
Right.
happened right now with the treasury market, because it's been so volatile, well, what's the biggest input into option pricing? Volatility.
Volatility.
So
Volatility.
volatility, treasury. If you
100%.
look at the move, pull up the move index. That's fine.
Just
So if
let me
you pull it,
let me. Yeah.
implied volatility is really high, right?
Right.
Once that volatility starts to come down,
Yeah.
right? If you are short an option and volatility is high, then that option is very expensive, but you're short of it, right? If you're short a call option and the volatility declines, that goes in your favor.
It does. It
So
does. Yeah. You're right.
as the yield curve, as inflation gets beaten down eventually, as monetary policy starts to normalize, the yield curve normalizes, implied volatility is going to fall.
Yeah. Yeah.
People
100%.
that are long mortgages are going to crush it because now that short option is going to get the volatility factor will start to shrink. So now the thing that is very expensive that you're short of will now become less expensive, relatively speaking.
Right.
Right.
So
So
here we have
mortgages,
a move in.
mortgage. Yeah, there's a move index. There you go.
There's the move
Pull,
index. Sorry. Sorry. Yeah. Here we
miss,
are.
pull up a big long graph of it, 5 years or whatever.
5 years. Here we go.
Yeah.
Here we go.
So there you
Yeah.
go. Look at the volatility on that.
It's yeah.
It's very high.
It's very
All
high.
right. Once
Absolutely.
that normalizes, um, that is going to really make the value of mortgage banks go up.
Wow.
All right. So
Yeah.
and then you get the double whammy of declining rates. All right.
So this is an asymmetric opportunity, taking advantage of the volatility and the discrepancy. Wow.
That's exactly it.
Right.
That's exactly it.
Wow.
Right.
You're right.
And
Yeah.
it's like a treasury on steroids. So you get duration, you get convexity, you get the option, blah blah blah. So this is a really great trade I'm looking at. And by extension, normalizing the yield curve. Any trade or
Yep.
any type of business that relies on carry, which is you borrow short and you lend
Right.
long, with the de-inversion is going to
Hmm.
make that very profitable. So Bill
Yep.
Gross has a point at looking at the regionals. Their business model, anybody that who's any entity whose business model relies on borrowing short and lending long in an inverted yield curve, it's death for them. The banks and whatever financials. You start looking at the opposite. Who's going to benefit the most from a de-inversion? So going back to excuse me, going back to the mortgage thesis,
Right.
you know, there's a couple of mortgage REIT holders. Pull up
Of course.
NLY, Annaly Mortgage. You know them?
I not only know them, but it's one of my it's one of my legacy one of my legacy traits that I've had for a long time, David.
You've probably been
I've owned,
suffering. You got some relief though. Look at the chart
I
last
have
in the last week. Look in the last week.
I've owned Annaly Mortgage for, don't laugh, for 10 years. Because we
You
you
got some
know
nice coupons though. You got some nice coupons.
that's
Nice dividend.
that's the only reason I kept it in my portfolio was for the coupons. And when you said Annaly, I said, is David really talking about my worst trade?
Yeah, that's. I think your worst trade's going to come back. So hold. Don't dump it now
I won't
because
dump it. No, I mean, I've been waiting 10 years for this thing to come back. So
so you know a normalized yield curve environment is good for this kind of with this kind of thing. Annaly is just a more. It's just a carry trade pass through. That's
it is.
all it is.
It is.
There's no rocket science behind it. They're borrowing today and buying
Yeah.
mortgages, but they're going to get the benefit of that mortgage um, acceleration that I was telling you about. So this is a way for retail, right? Retail, it's hard for retail to go out and buy mortgage backs on their own, but
Right.
this is kind of a synthetic way for retail to get access to the mortgage market.
Right.
Another one is similar one is REM. I forget what it stands for, but it's a lower quality one. Annaly is kind of the gold standard, but
Yep.
REM is it's similar.
Yep.
It's a similar chart,
Yep.
similar business model, similar
Yep.
funding model.
Yeah. Here it
You
is.
know,
REM. Yep.
yeah, there it
And
is. But
mhm,
it's got because it's lower quality. It has a little more convexity. I mean, I
it
think that
does.
it's
It
it's
does.
probably it's probably rebound a little more. But
What about
that yeah.
the yield steepener products? Like, I don't know if you follow iVol.
I don't. I mean, a lot of these I don't. A lot of these packaged products I stay away from just because they're
Right.
expensive and
Hmm.
they're hard to trade. So I prefer to express my thoughts on the yield curve just with Treasury
With futures.
futures.
Yeah,
Yeah,
yeah, I agree with you. A lot of our viewers are expert traders, and they have no problem playing the steepener with doing a purse trade with the futures. But for the retail traders, those are very great ideas. Now Annaly, REM, and in my point of view, it's a product that it's a steepener, and I like it because they use derivatives to create positive theta. Normally, all these products have negative theta because they use futures to create leverage. But this product, I think, it's less volatile, but it does play to the thesis of shorter rates coming down and longer rates popping up.
yeah, a normalization of the curve. So
Yeah.
that's kind of the right now. Just to close the commentary on that subject,
Yep.
that is the asymmetric trade staring me in the face right now. Is
Wow.
the more what's happening in the mortgage world. And then from there, you can build out whether it's how do you express it, Annaly, you express it with iVol, or you
Right.
express it with in other ways. But that's the one that's staring me in the face right now is the mortgage back trade. And
Yeah.
then this, yeah.
Doing a pair trade on the future is also quite easy right now with the new platforms. It's very easy to do it. Now the granddaddy of them all, the S&P 500.
Oh boy, oh
I'm
boy.
I'm an S&P trader to the core. So I can't wait to get your fair value, assessment of S&P. Where do you think it's going? Make me some money, Dave.
So yeah, let me make myself some first. Last week on the 24th, I modeled out a fair value of 4071 on the S&P 500. Every model is subject to its own assumptions. So I
Right,
was I was I was baking in, no changes to consensus estimates, no recession. The bond market, maybe hitting a standard high, a 10-year high, somewhere in the 525 area roughly,
right.
and risk premium is not really changing a whole lot. And I came up with 4071. We tagged 4103, I believe, a local low on Friday.
Yep, yep.
So I was about 32 ticks off just 3 days before that happened. So kind of a little lucky there.
Yep.
Luck always matters, I always
Yep.
say.
Yeah. Look
Anyone that
look at your call. It's right on the
and
money. It's right on the money.
anyone that rules out luck though is fooling themselves. I like to think that
Yeah.
luck plays a big role. But yeah, I got lucky 3 days before that. I nailed as close as you can get to a local bottom.
Wow.
And then we got a relief in the bond market, as I said, with the QRA and
Right.
the Fed and the lower growth estimates, and that really ignited the stock market. So I think if you go back to the bond market, and if the thesis is that this is a relief rally,
Yep.
then in rates, then that extends and carries over to equities. This is a relief rally in equities, and that this probably won't last. But look, we got earning. We're still in the middle of
Yep.
Q3 earnings season. I
We are.
think
We are.
I think it's still early to say, hey, we're out of the woods. I have no idea what the rest of the earnings package looks like. It could be great, it could be awful. I don't know. And besides but more importantly than the Q3 is the Q4 and Q1 guidance. That is more important. Q3 is, I think, basically a lock at this point. It's really what's Q4 and Q1 shaping up to be. Markets are forward looking, not backward looking. Third quarter is locked in at this point for the most part.
But just take a look at the bounce, David. I mean, it's 5 trading days. I mean, it's crazy. It's
Yeah,
crazy.
it mooned up. So I need to rerun my pricing model this week, and I like to use end of week data. It matters more to me than
Yep.
daily and intraday is obviously very volatile. And I need to also recheck the assumptions on that with the growth assumptions. But I think you know what's really changed, other than the deceleration, not a whole lot. Again, the worst case is taken off the table, but I'll rerun my model and see where we are. And I'm a conservative investor by I trade my own money and my family's
Right.
money, so I got skin in the game, and
Yep.
I got to see people at Christmas and explain myself to them if I end up with egg on my face. And that's never a fun conversation to have. So I run very conservatively.
Mhm. I
And
also trade a lot S&P. It's one of my like bread and butter. Maybe 70% of my trades are S&P, and I was luckily I wasn't short at the bottom. Luckily, I'm almost always on the wrong side, especially on the up moves. But I started shorting after I when I stopped losing money on the upside is I use something called T plus three, which is Tony plus three. Whenever I want to short the market, I wait 3 days to
that's
short it.
smart.
And
That's
because
smart.
I get the urge, I want to short it, I want to short it, and I said no, Tony's T plus one. Then I want to short it, I want to short T plus two. And so today, finally, I said F it, and I started shorting the S and P's, and we've been while we've been talking, it's been rallying, and I'm a little bit underwater, but I do see that 4,400 might be at least a place it should stop. But the 10-year going from 5% to 455 this morning, it's just like adding fuel to the fire. It's like
Yeah, that's yeah, it's this is
I
all
mean
this is all
it's
treasury rally
it's
driven.
unbelievable.
So I'm not a big shorter just because of my risk tolerances, but I would look to I would not be adding here personally. I'd probably wait for another. If this relief rally runs out of steam and we get a pullback, then I'll reevaluate and look to go long there. And
Right.
I update my models weekly, so if folks want to follow that, they can log on, subscribe, and check that out and see where I am at any given point in time. For now, I would not be touching. For long term asset allocation, that's totally different. But for active intra week trading, I would not be adding risk here
Yeah,
personally.
one of my best buddies, he's a big believer on the Trader Almanac and seasonality and everything. And he kept telling me this is the every year. And this week he told me this is the most bullish week of the year. And I always tell him that's BS. And if you look back, just for fun, look at this week. The prior 2 3 years, it's been crazy how it's moved up. But this week, I thought the almanac's going to be wrong because the Fed's going to be more hawkish and we're going to crash down. And oh my God, I got egg on my face. And once again, the almanac, which I don't really believe in, was right again. The most bullish week of the year again. The last week of October, first week of November. It's
Yeah,
unbelievable.
I think what's interesting is going to be how Black Friday shapes up, right? You talked about
Right.
earlier in this when you first started, you start talking about the consumer. It'll be interesting to see how Black Friday shapes up, and Cyber Monday, I think it is. I'm not a
Yeah.
shopper, so my wife does a lot of shopping. So,
Right. Right.
but it'll be interesting to see how that clues in. And typically, you know, since I've been doing this, we don't get any, the year end rally, that the seasonal year end rally, which again, that's always, it is what it is. Um, Typically when that kicks in, it's a little later in the calendar year. It's not so early, just because again, we have more risk events coming up. We have CPI, we have another non-farm payroll, we have a Black Friday, we start to finish up Q3 season. So I think it's hard to say, we've hit a local bottom for the year and we're done and Santa rally. Maybe a Santa rally happens, but I would not be, adding new risk in anticipation of a Santa rally at these levels. I'd probably wait,
Yeah.
just because I'm a tend to be conservative investor.
Now, I tend to agree with you that this rally was so crazy for my kids' accounts. I do what I call a spy put campaign. What does that mean? So I try to look at 20% down on S&P, and I sell in their portfolios. They sell a put 1 year out, 20% down, and that normally gives you a like 12 to 14% return on that put. So last week we sold a 340 spy put, believe it or not, for December of next year for $10. It's $6 now. So
Wow.
in 1 week, something that should take 6 months to normally after 6 months, normally the premium is around 50%. So in 1 week they took out 45% of the premium of those puts. And
Wow.
because my kids don't have enough money to buy a rental property, so I tell them that selling puts on the S&P 500 1 year out is equivalent of, because the capital required for that trade is around $8,000. So if they get 12, $1,000 or $1,100 premium on that, that's equivalent of having a rental property that yields almost 1% a month. And that's how I'm trying to teach them how to get some even though it's not uh, passive
Oh,
income. It's
lucky
it's
kids.
I have thank God I have great kids, but not everybody has money to buy a rental property. So this is a cheap, easy way for someone to get. And if the stock market goes down to 340 on SPY, I mean, what the heck? They should own assets when they're on sale. That's
Sure. Yeah.
so.
Yeah.
I'm not afraid for them owning the S&P at 340. You know,
Yeah.
they're 24, 25 year olds. So it's great. I am worried about a Santa rally because they always manipulate, in my point of view, the market up at the end of the year. They mark up their portfolios. Everybody gets paid. Financial advisors. You and I are traders, but financial advisors, they get paid on keeping their assets. They're asset gatherers, and they get fees on their assets. And they, of course, they have a vested interest in keeping those assets and showing good returns. And they also love to chase. You see how they chase it up. And
Yeah. 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 Yeah.
so I'm afraid we might get a Santa rally. But you're right. If the earnings are not going to be there, and if we do go into a recession, even a mild recession, the S&P is not going to be that flying cow that is right now.
Yeah. I mean, a recession is typically not kind to earnings. Your run of the mill, your run of the mill recession wipes out earnings by about 15%.
Wow.
That's average. And then a really bad recession can, knock off 30% or more. So that, in terms of, the long stream of cash flows, that is just horrific, for the index. So I personally, I don't see a recession in the cards right now. I mean, like any forecast out past 6 months is really hard to
It is.
to make. But right now the economy coming out of Q3 was 4.9%. Even if we slow to a one-handle GDP, which is not my expectation, it's still positive growth. And then we still have Q1. It takes a long time to slow an economy. Absent of some shock, it takes
Right.
us a long time for an economy this size to get to a recession level. It's just such a big economy. $28 trillion is a massive
It's
amount
huge. It's
of
massive.
money. So I would not be looking at recession trades right now. I think it's very early for that. It's premature, in fact.
Right.
I think if you start putting on recession trades right now, that's a high risk proposition in my
Right.
view.
Right. Oh, David, you have no idea how much I enjoyed, first of all, talking to such a smart person like you. And then, because you're a trader, you know how to make money trading. And you gave us so many great ideas. You gave us ideas on the bond market. You gave us ideas on the yield steepener, on real estate, on oil, on the S&P. Oh, my God.
Mortgages.
Mortgages. Are you kidding? I'm going to go back and look at my annually mortgage crap that I have. I've had it forever. And the reason I bought it was, when there was no yield, I said, what the hell? I always like to have a portfolio of dividend stocks to create
Yeah,
some
that's
equity.
a high yielder. I think the yield on
It
that's
is.
like 11%.
It's a
Something
high
crazy
yielder.
high.
Yeah, I
Yeah, I
also
mean, there's
buy, bank preferred stocks for
okay.
yield, and
Yep.
because remember, I'm much older than you, but there was no interest to be had in the last 10, 12 years. So I used to buy all this crap, Annaly, AT&T, bank preferreds to get 4 or 5% yield, and mainly, finally, my dog is having its day, and I'm so happy about it. I'm so
Well,
happy about it.
don't throw away Annalie. Yeah, keep that baby for a while.
That's the problem with a trader. He gets back to even on a bad trade, and boom, we're gone. But I'm
Yeah.
gonna listen. I'm gonna listen to you now that this is on tape. I'm gonna keep my
Oh
annually.
boy,
I'm gonna
it's
keep
on
my annually
it's on tape
mortgage.
now.
I'm gonna keep it. And but oh my God, I got so much insight, so many great trade ideas that you know my viewers, your viewers can monetize on. And it was because all the time we're looking at smart people on TV. We read smart people on their newsletters, but not everybody has the way to articulate the way you can articulate the idea and turn it into a trade that can generate money. And that's a great skill. And I applaud you for that, David. I really
Thank
enjoyed
you.
our talk today. I had
Thanks for
a
having me.
great time.
Thanks for having me. I really appreciate it.
Thank you. And I like to end everything by saying, if you want to grow your pile, follow David Cervantes. He has a great newsletter. You can subscribe to it. You can follow him on Twitter. I follow him religiously. And also follow Uncle Tony. And remember, you got to risk it to get the biscuit, baby.